As active investors, we all want exactly the same thing: to consistently beat the market and earn superior returns. The intuitive way to do this is to look for companies generating massive excitement. When everyone is celebrating a stock, it feels incredibly safe to jump in alongside them. Think of a company like Tesla. When Elon Musk dances on stage, retail stockholders cheer, and earnings hit triple digits, the horizon looks perfectly clear. But there is a mathematical problem with this strategy. When a stock is priced to perfection because of universal hype, there's absolutely zero room left for positive surprises. The upside is already capped. Realizing this, investors often turn to another intuitive strategy. They try to time their trades by endlessly debating macroeconomic factors, placing bets on where inflation, on interest rates, or global conflicts are heading. The greatest capital allocators treat this kind of forecasting as a complete waste of time. Warren Buffett's team has managed money for over half a century and freely admit they never base a stock decision on macroeconomic predictions. Following popular hype and guessing the direction of the global economy are obvious moves, and doing the obvious things guarantees average or even below average results. To reach the level of a self-made billionaire like Howard Marks, we have to adopt a completely different analytical framework. Marks argues that you get much better results when you fish in the right pond. This means abandoning the fixed notion of what you want to own and deliberately hunting for assets that motivated sellers are hastily discarding at a steep discount to their actual value. One excellent place to cast a line is among little-known entities. Corporate spin-offs and smaller enterprises often fly completely under the radar, giving you a chance to uncover mispriced assets before the broader market appreciates them. Another promising pond contains seemingly outdated or unglamorous industries. Take the business of physical cash transit, like Brinks. It rarely grabs headlines, but that lack of attention creates unique pricing opportunities because other investors dismiss it so quickly. Then there is the pond of the controversial or terrifying. Heavy industrial oil operations, war-related companies, or the gambling sector. These assets are frequently ignored out of immediate fear or moral distaste. What makes these ponds so valuable is their perceived defects. Widespread, unthinking pessimism pushes the price down severely relative to its real value. You pay very little, which limits your risk, while leaving enormous room for outsized returns. To evaluate these discarded assets properly requires a rigorous cognitive framework. Just as an elite bodybuilder needs a far more disciplined training regimen than a casual gym-goer, an elite investor requires what Marx calls second-level thinking. When the financial outlook is poor, the first-level thinker says, "Growth is low and inflation is rising. Let's dump our stock." The second-level thinker says, "The outlook is terrible, but everyone is selling in a panic, which means the asset is incredibly cheap. Buy." The master investor Charlie Munger has a specific way of forcing this deeper analysis. He constantly asks, "And then what?" to push past the initial, obvious conclusion. Let's apply that to the current market. A first-level thinker looks at artificial intelligence and says, "AI is the future, so I should aggressively buy AI stocks." But a second-level thinker asks, "And then what?" They realize that because everyone knows AI is the future, valuations are crazily inflated. They also recognize that every entrepreneur in town will compete for this market, ruthlessly destroying profit margins. Therefore, it is a terrible investment. Superior market insight doesn't come from identifying an obvious trend. It comes from accurately predicting the secondary consequences that the rest of the market has ignored. Instead of wasting time acting like macroeconomic pundits, successful investors operate more like the baseball scouts from Moneyball. They completely ignore flashy distractions and endless arguments about meaningless stuff to focus purely on hard, measurable data. It is tempting to point to someone like Michael Burry, who famously shorted the housing market before the 2008 financial crisis, as proof that macro forecasting works. But for every investor who correctly timed that single major event, almost none successfully predicted the massive rebound that followed. Elite capital allocators willingly accept the limits of their predictive capabilities. They know that forecasting global crises or the exact movement of interest rates over the next 12 months is simply impossible, so they obsess over what is knowable. They dive into the nitty-gritty details of specific companies, evaluating how a stock is priced relative to its peers, how efficiently it generates cash flows, and whether its competitive advantage is actually sustainable. Redirecting your analytical energy away from the unknowable noise of the broader economy and funneling it entirely into specific company mechanics is the single most profitable shift an investor can make. The Hollywood image of investing is filled with chaotic trading floors, rapid-fire decisions, and genius traders gazing into a macroeconomic crystal ball. The reality of true capital allocation is completely different. It is highly disciplined, quiet, and frankly, quite boring. It requires spending countless hours alone, reading deep into company financials. But the hardest part isn't the math, it is the psychological requirement. You have to possess the emotional fortitude to stand apart from the crowd and look completely foolish to the broader market in the short term. You cannot find unappreciated value if you are constantly participating in crowded, popular trades. Consistently beating the market demands a trade-off. You have to sacrifice the emotional comfort of agreeing with the herd in exchange for the rigorous, lonely, and ultimately profitable logic of second-level thinking. Let's look at this chart of two hypothetical investors over a decade. Investor A's returns outpace B's, hitting a massive 23% annualized return compared to B's 13%. Based strictly on this historical performance data, who is the superior investor? The natural reflex is to point to the person who made the most money. But evaluating financial success by only looking at the final percentage creates a massive blind spot. That single top-line number tells you nothing about the hidden risks they took to achieve it. Imagine two cars driving up to a snowy mountain cabin. One driver pushes the limit, making the trip in 5 hours versus 6. The 5-hour driver reached the destination faster, but to shave off that single hour, they took a 35% higher risk of a fatal crash along the way. This brings us back to our 23% investor. Reaching a financial goal faster requires dangerous maneuvering, and if the strategy relies on massive, unchecked risks, surviving the trip requires huge luck. True investing supremacy rests on risk-adjusted returns, a metric often referred to as alpha. This measures performance generated strictly through skill, accounting for the hazards taken to reach the destination. To understand why alpha is so rare, you have to look at the environment. The stock market is heavily influenced by entirely random, uncontrollable events. An earthquake hits a supply chain, a government changes a regulation, or a foolish corporate acquisition. Because of this underlying randomness, not even financial grandmasters can guarantee outcomes the way a chess professional can. If the board itself cannot be controlled, an exceptionally high-yield track record is rarely the result of genius. Usually, it's an illusion, masking 3 telltale signs of reckless gambling. The first metric to check when analyzing an investor's true skill is their historical portfolio diversification. Compare someone who bets their entire net worth on a single lucky tech stock against an investor like Peter Lynch. Lynch built a legendary track record while holding many hundreds of different companies across various sectors, proving his overall strategy worked across the board. Warren Buffett is famously more concentrated in his positions, and there are managers who make large bets on a few assets. But broadly speaking, if an investor's massive historical returns are entirely tied to one specific asset skyrocketing, the result looks less like repeatable skill and more like a single winning lottery ticket. The second red flag is leverage, the practice of using borrowed capital to artificially inflate your position. Looking at this chart, you see how leverage mathematically accelerates gains during a decade-long bull market. The borrowed money pushes returns so high, it creates an illusion of absolute genius. But the fatal consequence of leverage appears the moment the market contracts. It only takes one severe drop to completely wipe out the entire portfolio. No matter how spectacular your historical performance was on the way up, leverage is fundamentally a structural vulnerability. Eventually, your luck runs out, and multiplying a lifetime of success by 0 still leaves you with 0. The third metric to look out for is overall market valuation. This is exactly where aggressive tech investors often run into trouble. It takes absolutely no alpha to generate massive returns when the entire market is gripped by euphoria, heavily overvalued and rushing upward. The actual test of a track record happens when the bubble finally bursts. You have to look at how severely that aggressive portfolio crashes in comparison to the baseline market. If those historical returns disappear entirely during a downturn, Their success was merely the result of market volatility. They simply surfed a wave without fully realizing it. In financial markets, there is a very clear dividing line. There are bold investors and there are old investors, but there are no bold old investors. Think about it like a game of tennis. When professionals play, they take complete control. They know their mechanics will result in a specific outcome, so they play to win by hitting aggressive, calculated smashes. Amateurs cannot do that. An amateur has the greatest chance of winning by simply playing not to lose. They focus entirely on getting the ball over the net and waiting for their opponent to make an unforced error. Because the stock market is governed by uncontrollable randomness, we are all amateurs in the game of investing. The only mathematically sound approach is to play defensive tennis and refuse to make unforced errors. Defensive investing operates on very strict parameters. You only buy companies within your specific circle of competence. You reject frothy valuations, you avoid leverage entirely, and you demand a strict margin of safety on every purchase. To maintain this discipline, you actually have to invest scared. Constantly worrying about the possibility of an unexpected loss is the only thing that prevents hubris. The true power of this approach comes down to the math of compounding wealth. If you consistently avoid catastrophic losers, the winners will naturally take care of themselves. Prioritizing defense and survival over aggressive speed protects the portfolio from ruin. This mindset ensures that you stay in the game long enough for wealth to build over time.